discovering how some of the investors put fundamental analysis to use, uncovering clues on when to buy or sell a stock, applying fundamental analysis to buy and hold investment strategies. Fundamental analysis is not the easiest way to invest. There is a bit of math involved. You will need to learn some terms and to perform fundamental analysis. You need to ferret out and analyze somewhat arcane piece of financial information. Why go to all this trouble? That's the question you will find the answer to in this chapter. You will discover why the rigorous of fundamental analysis and the ultimate goal of not overpaying for stock and finding cheap stocks to buy can help you obtain better long-term success in investing. Meanwhile, you will see how some basic fundamental analysis can help you to avoid making mistakes that will be difficult to recover from. Of course, no discussion of fundamental analysis is complete without exploring its best known master, Warren Buffett. Buffett is a hero in investing thanks to his discipline and long term ability to find and hold companies with attractive fundamental characteristics. Finally, in this chapter, you get a general taste of how fundamental analysis can give you cues on when you might consider buying or selling stocks. No method will work 100% all the time, but fundamental analysis can add. Let's provide a guide and keep you from getting caught up in stock manners and bubbles. Better investing with fundamentals. One of the biggest strengths of fundamental analysis is the fact it attempts to help you keep the emotion out of investing. While momentum investors chase after the hottest stocks, hoping they will go higher, and day traders buy and sell every few minutes, looking for a quick buck, fundamental analysis is more of a data-driven discipline. Fundamental analysts analyze investment by examining the business that's behind a stock or bond. Even if you are just looking to buy a few shares of a company, you approach the analysis with the same level of research or due diligence as if you are thinking about buying the whole company. Fundamental analysis lets you approach a stock as an investor, not a speculator. Remember, investor looks to buy a stock because they believe the underlying company will generate profit in the future that exceed the price they are paying. Speculators look to make money on an investment by simply finding someone else to sell it for a higher price. The careful consideration of a company's fundamentals such as revenue and earnings is a key distinction of this approach from other methods of choosing investment. The name fundamental analysis really says it all, as the approach gets down to the most basic aspects of a business, including the trade cycle, which is discussed in Chapter 2. Fundamental analysis is generally connected with value investors. Value investors tend to buy stocks they think are undervalued or have stock prices below what they think the company is actually worth. But fundamental analysis can you help you no matter how you invest. Perhaps you are a technical analyst who studies stock chart to find stock to buy. Maybe you are an index investor who buy all the stock in a broad stock market index such as the Standard and Poor's 500. No matter what kind of investing you prefer, fundamental analysis can help you find suitable stocks and investments. Picking stocks for fundamental reasons. Value investors are often drawn to the idea that they can get an edge on other investors by doing their homework and studying a company's financial statements. These investors believe if they put in the time to understand a company's business, accurately forecast its future, and pay the right price, they can achieve greater upside and less downside than the market as a whole. There is some truth to this. Academic studies have shown that stocks that are cheap or value priced tend to have strong long-term performance. Need proof? Table 3.1 shows how so-called value-priced stocks have performed compared with so-called growth stocks. Value-priced stocks are those that are cheaper than the market based on fundamental metrics, like the ones you will be hearing about a great deal in this book. Growth stocks are those that are more expensive than the market. The numbers speak for themselves. Cheap stocks win over the long term, and it gets better. The edge of value stocks carries over to companies of any size, large or small. Tip: Fundamental analysis can also help you protect yourself from your own speculative juices. By studying the cold, hard numbers of companies' business, you can get a strong dose of reality while other investors get caught up in hype surrounding a particular stock. Because fundamental analysis is based in laws of business, it can give you a greater perspective on how much an investment is worth. Fundamental analysis allows you to have a pretty good idea of what a company or a stock is worth, even before you buy it. That's critical in investing where the price of stock are not always the same as the value of company. How can that be? Value and price are determined by two different things. A stock's price is determined by an action, very similar to how the price on a page dispenser is set on eBay. Investors potentially buy and sell stock every trading day, pushing the price up and down based on how optimistic or pessimistic they are about a company's future potential that second or even nanosecond. Just as you can see a wedding vow erupt over a page dispenser and push its value to extreme highs, the same can occur for a stock if many investors are willing to buy it. A company's value is very different and quite disconnected from the noise on Wall Street. A company's value is a mathematical measurement of what the company is worth based on how much profit it generates and how much growth is expected to generate. The value of a company does not change second to second, quite the opposite. Tip: John Bogle, founder of Vanguard Investment Company, separates the true value of companies from the market value determined by Wall Street noise. Bogle says the value of companies is determined by the slow creep up bar of their dividend and earnings, which he calls the investment return. Then there is the speculative return, which is the price the traders are willing to pay for some shares of that company at that moment. Speculative returns are not rooted in anything other than how much traders are willing to pay. When you start paying more attention to the speculative gains, you are setting yourself up for trouble. In the short run, speculative returns are only tendentiously linked with investment returns, Bogle says. But in the long run, both returns must be and will be identical. In other words, the company's market value will eventually match the fundamental values. A great example of how fundamental analysis can help you is for the frenzy over a stock causing its price to get out of line occurred in March 2000. Soared 150% in their first day of trading to more than $95 a share. At that price, investors put a total price tag of $54.3 billion on company and its 23 million shares. Just a little bit of fundamental sleuthing could have protected investors from the coming visual collapse in the stock. Here is how. Palm Computing was 95% owned by its parent company, 3Com, at that time. At the entire value of 3Com, including its 95% share stock in Palm Computing, was just $28 billion. So, why would investors be willing to pay nearly twice as much for a 5% piece of Palm that they would the entire parent company, 3Com? This kind of madness so investors lose sight of fundamentals. It's kind of like paying $20 for a slice of pie when you can buy the whole pie for $10. Fundamental analysis knew something was a little off, and they were right. The stock lost more than 70% of its value in just 7 months. Uses for the indexed investors. Indexed investors don't try to pick individual stock or time the market. Index investors buy a broad basket of investment and hold it for a long period of time. See Chapter 2 for more on index investors. Many investors think trying to choose a stock that will outperform the broad market is extremely difficult, if not impossible. As a result, index investors buy a small stock of hundreds of companies so that any difficulties that arise at one firm won't hurt much. Index investors often say fundamental analysis is a waste of time. Even so, many index investors apply some aspects of fundamental analysis. Index investors routinely choose to invest in basket of either value stock or growth stocks. Value stocks are those that are largely ignored by investors and command low stock prices relative to their fundamentals, such as profit or asset value. Growth stocks, on the other hand, are the darling of Wall Street and demand huge stock prices compared to their fundamentals. It's not just values versus growth that index investors pay attention to, but also the size of company. Index investors often divvy up money between share of large companies and small companies, as companies' size often have a bearing on what kind of returns to expect. Large companies tend to generate lower return than smaller companies, but they also tend to be less risky. These measures of size again are rooted in fundamental analysis. Market value, also known as market capitalization, is the total price tag placed on a company and a good proxy for its size. Market value covered again in more detail later, bears mentioning how now because it's so important to index investors. Market value is rooted in fundamental analysis. A company's market value, you will need to calculate its number of shares outstanding, which comes from the balance sheet. You calculate a company's market value like this stock price into company's number of shares outstanding. So what? Does this mean the company is large or small? Table 3.2 does the work for you and shows you how to know if a company is small, mid-sized or large. Measuring the size of companies. Why the three factors matters? It's rare that academic research can make you money, but one of the most influential pieces of academic research ever written about investing is certainly worth your time. Professor Hugh Farmer and Kenneth Ferenc found that nearly 95% of stock price movements are explained by just three things, two of which are determined by a company's fundamentals. First, size. Share of a smaller company is measured by first size. Share of a smaller companies measured by market value tend to beat the stock market, in part because they are riskier and less established. Market value, also called market capitalization or market cap, measures the total price the market assigns to a company by multiplying a stock price by the total number of its shares outstanding. You will find out more about market capitalization later in this chapter. Second, price or value. The lower a stock's price relative to its book value, the better it tends to do relative to the rest of the stock market. Book value is a key aspect of fundamental analysis, as you will read about in chapter 8. For now, know that book value is much like the net worth of a company. It's the company's total assets minus liabilities. This is fundamental value or equity in the stock. Market risk. Third, movements of the broad economy have a large sway on how individual stocks perform. This is the part of stock values not determined by fundamental measures. Market risk can be very important in the short run, but eventually the fundamentals win out. Assisting technical analysts. Like fundamental analysts, technical analysts think they can beat the stock market by picking the right stock at the right time. But unlike fundamental analysis, technical analysis calls for a close study of stock price movements over time. Still, technical analysis can benefit from fundamental analysis too. For instance, some technical analysts might look for companies that are increasing their revenue or earning growth each quarter. This information is found on a company's income statement. Similarly, technical analysts might look for the best company in an industry by looking for companies with the most attractive financial ratios. Dooming your portfolio by paying too much. No matter what type of investor you are, there are several absolutes. Here is one of them. If you overpay for a stock, you are accepting a sentence of poor return in the future. Your return on a stock is a function of how much you pay for it. By definition, the more you pay for an investment, the lower your return will be. Imagine you have the opportunity to buy a laundromat. The laundromat has been open for 30 years, and in each of those years it generated a profit of $1 lakh. Because the laundromat is in a strip mall that will close in 5 years, you figure the business will generate $5 lakh in profit over the years and then will be shut down. Technical stuff. To keep this example simple, forget about the role of inflation or the decreasing value of money each year. At this point, also assume that your estimate was correct and the laundromat generate $1 lakh a year in profit. Just imagine what would happen if you offered to buy this laundromat for $2 lakh. Your gain would be 150%. You know this because your profit is $3 lakh, because that's the difference between the lawnmowers earning $5 lakh and what you pay $2 lakh. Your return is your profit of $3 lakh divided by the price you pay $2 lakh. Now, what if you got into a bidding war with another person interested in buying the lawnmower? In the heat of the moment, you offer to buy the business for $4 lakh instead of $2 lakh. Your return will take a big hit, now qualifying 25%. Nothing changed with the lawnmower. It will function the same whether you paid $4 lakh or $2 lakh. But your return is now the profit of $1 lakh divided by your purchase price of $4 lakh. The same goes for investment, including stocks and bonds. If you increase the amount you pay for a share of a stock, or for instance, you eat into your return. Remember, overpaying for a stock is even more dangerous than increasing your offer for the lawnmower. If a company you invest in suffers a slowdown and its earnings are smaller than expected, you will find your return to be very small, or you may not get back what you invested. Sitting through short-term volatility. Sometimes the excitement of daily market activity can got into exhausting. Ticker symbols scrolling at the bottom of the TV screen during financial program can make you feel as if the market are constantly moving and changing. And that's sure. Markets are constantly moving as an investor trade shares back and forth and push stock price up and down. This is how the speculative return, as described previously, gets generated. But a fundamental analysis can help you block out a great deal of this noise and be a better investor as a result. An example is perhaps with your house. Let's say you are living in a home you know is worth 2 lakh dollar. You know that because you hire an appraiser to look at the condition of the roof, remodeled kitchen and bath, as well as look at the price of identical homes in the area. You have a pretty good idea of what the house is worth. With this in mind, would you panic if you were sitting on the patio while a person walking by randomly offered you 1 lakh dollar for the home? Probably not. After all, you know the home is worth more than 1 lakh dollar. Besides, you are not in the market to sell anyway. Still, that's what stock investors commonly do when they pay too much attention to day-to-day movement in stock prices. They may have felt great about buying a stock for $10 a share, but if the stock falls to $8 a month later, they panic and wonder if they should sell. It does not have to be that way. Remember, one of the mantras of fundamental analysis comes from Benjamin Graham, the pioneer of methods and mentor to Warren Buffett. Fundamental analysts will often say the market is a voting machine in the short term but a weighing machine in the long run. In other words, stock prices can be kicked dramatically higher or lower in the short term, but over the long term, the underlying value of a company will prevail and its true health will be recognized. Fundamental analysis helps you focus on investments' true value or weight using Benjamin Graham's analogy. If you know you correctly analyzed a company and assigned the correct value to it, then you don't need to be as concerned about whether or not a company is popular or not in any given day, month, or year. Having a fundamental grasp of a company gives you the peace of mind to hold an investment for a long period of time and resist the urge to sell the wrong time. Relying on the basic info, the pros use. It's natural to think successful fundamental analysts have some kind of secret that's beyond the reach of regular investors. Looking at the long-term success of Warren Buffett, for instance, make you think perhaps he has a supercomputer that's able to forecast the future. Similarly, many analysts who study companies have deep insight about their businesses, which might lead you to think they have access to data you don't. But here is the truth. Fundamental analysts, with a few exceptions, are using all the same financial statements you have access to. Even the professionals are looking at all the same things I will show you in this book, such as first, the financial statements. Income statement, balance sheet, statement of cash flows, and ratio are cornerstone of analysis done by most fundamental analysts. Second, the financial ratios. These seemingly simple calculations put the number in the financial statement into perspective. That perspective helps you determine if stocks are cheap or expensive. Third, industry analysis. Understanding the dynamic of the industry a company is in can help you better job investing. Fourth, economic analysis. Investment can swing in value based largely on how the broad economy is doing. The influences of the economy became clear in 2008 when shares of companies having nothing to do with subprime loans were dragged down with the financial decay. But fundamental analysis also helps investors pinpoint companies that would benefit most when the economy recovered. Stocks more than doubled from the lows of 2009 throughout 2015. Remember, clearly the pros do have distinct advantages. Large investment firms can afford to deploy armies of research experts to pore over the financial statements, allowing them to trade while you are still downloading the results. Some systems used by professionals make fundamental analysis easier by automatically calculating growth trends and the financial ratios. Experience can also be a big help in helping a fundamental analyst spot things that a beginner might miss. But that does not mean you can't use fundamental analysis to help boost your success. What is the Warren Buffett way? For many fundamental analysts, Warren Buffett is the ultimate role model. There is no denying his success. Shares of Buffett's Berkshire Hathaway rose from $87,800 a share to $2,406,24 in the 10 years ending November 2014, an impressive 133% gain. That works out about 8.8% a year on average. During that same time period, the Russell 3000 index, which measures the performance of the stock market in general, gained 7.5% in value including dividends according to Russell Investments. Buffett's long-term record is strong too. No wonder he is called the Oracle of Omaha. Trying to figure out Buffett's success secret is the investment world's equivalent of the research for the Holy Grail. Scores of investors made the pilgrimage to Berkshire's Hathaway shareholder meeting in Omaha each year, trying to figure out how Buffett does it. Hour-long lunches with Buffett auction off on eBay for hundreds of thousands of dollars, and there are countless books on Buffett, most notably The Warren Buffett Way. Interestingly, though Buffett does not make much of a secret of his techniques, every year in his letter to shareholders and also in Berkshire Hathaway Owner's Manual, he paints a picture of his approach. If you are looking to up for your fundamental analysis game, you are wise to learn from the master. Much of Buffett's approach is based in key elements of fundamental analysis, including invest as an owner, not a trader. Buffett is very clearly that he looks at an investment not as a short-term trade but a long-term relationship. Berkshire Hathaway will often invest in a company and hold it for a very long time, perhaps never selling the position. Regardless of price, we have no interest at all in selling any good business that Berkshire owns, according to Berkshire's Owner's Mutual Manual. Consider carefully a company's intrinsic value. Buffett repeatedly discusses intrinsic value, which is a measure of what a company is truly worth. Intrinsic value is how much cash a company is expected to generate over its lifetime, which is a good measure of what's its worth. Buying a stock for less than its intrinsic value gives you a bit of margin of safety. You will find out how to calculate companies' intrinsic value in chapter 11. Analyze management. Buffett routinely says even a seemingly ho-hum company can generate dazzling return with a good management team at the helm. For that reason, Buffett will often leave the top officers and directors of a company in place even after buying a company. A stick with business you understand. The better you grasp how a company makes its money and operates, the more informed you will be after reviewing its financial statements. You will know better what to look for because every industry and company has unique financial traits. Find businesses that have a real advantage. In capitalism, if a company has a good idea, other firms will try to copy it and steal away from market share. Buffett compacts that by investing in business with a strong brand or a unique product such as Coca-Cola. Tip: Many an investor hopes to profit like Buffett without actually learning fundamental analysis. There are plenty of ways to do that. Investors who want to ride Buffett's coattails could just invest in Berkshire Hathaway shares. Others try to mimic what Warren Buffett does. Some investors try to figure out what Buffett is investing in by reading Berkshire Hathaway's annual report, a document that discloses all the firm's large holdings. It's never a good idea to blindly buy stock just because another invested. Still, reviewing the stock that passes Buffett's fundamental analysis might be a good place to start. The list of Berkshire Hathaway's holdings and publicly traded companies can be found in the company's annual report available on the website. Table 3.3 shows you what some of Berkshire's biggest positions were at the end of 2014. Warning: blindly following moves of top investors is not instant road to riches. That's especially the case when trying to take cues from Buffett. Buffett constantly reminds his shareholders that he plans to hold investment for a long time, and his holding can also suffer large losses in the short term. For instance, had you bought Tesco at the beginning of 2008, after seeing it was a top holding at the end of 2007, you would have suffered a 75% loss. Shares in American Express, a big holding going into 2014, lost a quarter of its value in 2015, and IBM dropped about 50% when Walmart fell by nearly a third. Sometimes even Buffett's speculative plays don't pay off right away. Checking in on Graham and Todd. As much as Buffett is reversed and admitted he too was a student of fundamental analysis, Buffett has utilized and perfected the tools of Professor Benjamin Graham and David Todd, who are discussed at more length below. Graham and Todd, whose names are synonymous with a method of investing called value investing, trace their roots to Columbia University, which Buffett attended. The origin of value investing. Value investing, along with the work of Graham and Dodd, is usually central to the work of fundamental analysis. Graham and Dodd explain the stock is really a claim on the cash a company is expected to generate in the future, or its intrinsic value as referred to above, just known if a stock is trading for less than the cash it will generate is undervalued and may be bought. More than the value of a cash a company is expected to churn out is overvalued. Using fundamentals to see when a stock is priced right. Graham and Dodd took things a bit further than just weighing whether stock were or undervalued. Other lessons from Graham and Dodd worth nothing include protecting yourself. Buy stocks well below what they are worth or other intrinsic value. This extra cushion gives you a margin of safety in case the business runs into trouble and the stock price falls further. Investing is not necessarily speculating. While it's tempting to think of Wall Street as a giant casino, Graham and Dodd explained that was not necessarily the case. If you are buying a stock with little information about the company's business, then yes, you are betting or speculating. When you speculate, you bet you can sell the stock to someone else for more, but with fundamental analysis, you can become more of an investor by understanding what you paid and what you can expect to receive in exchange. Being cautious of companies with excessive debt. Companies that are borrow heavily to finance their operation may face onerous debt payment during difficult economies. Figuring out when to buy or sell a stock. Most investors are frustrated by the difficulty of getting the timing just right when buying or selling stock. Even professional investors complain that while it's hard enough trying to find the right investment and buy it at a good price, it's even harder to know when to sell. Mm, Fundamental analysis can help you with this because you will learn how to estimate what a company is worth, as discussed above. Knowing what a company is worth is very helpful because you will know whether the current stock price is higher or lower than what you think the company's value is. Remember, on the flip side, the discipline of fundamental analysis can help you evaluate when you might want to sell a stock. If a stock price is well below what you think the stock is worth, why would you sell at that price? You had to. Looking beyond the per share price, looking at just about any financial website and the screen will be covered with stock prices, probably flashing green or red as they move up or down. Many investors get obsessed with the per share price of a stock. It's easy to understand why. When you buy a slice of pizza, for instance, you might not think to calculate how much. Based on the per slice price, how much you are paying for the entire pie. But one of the basic premises of fundamental investing is just that you want to know how much you are paying for your slice of a company and how that compared to what is really worth. And if there is one aspect of fundamental analysis you can use immediately from this chapter, is that the per share price of stock by itself does not tell you too much. Tip: just looking at a company's per share price can lead you to make incorrect judgment. Some investors, for instance, have puzzled over how shares of Visa could trade for less than $80 a share while rival MasterCards command a price of upwards of $100 a share because Visa processed more credit card transactions than MasterCard does. You might assume Visa is a better value than MasterCard because the per share stock price is lower, but that's not necessarily the case, and you need to take the analysis beyond the stock price. Technical stuff. Fundamental analysis, though, will show you that Visa's lower per share price does not mean it's screaming buy. Remember, market value mentioned earlier? Well, it's back again. Market value tells you how much investors are paying for an entire company based on the price of a single share of stock. Using the pizza metaphor, market value tells you what the price of whole pizza is. Based on the price of one slice, you can apply this information immediately to stock by using this formula. Market value is equal to share price into number of shares outstanding. The key parts of market value are: first, share price, how much investors are willing to pay for a slice of ownership in a company. You can get a company's share price from many resources ranging from your online brokerage firm, investing websites, or in the business sections of your newspaper. Number of shares outstanding, the number of slices or shares a company's value is cut into. The number of shares outstanding is value in a company's balance sheet, as described more fully in chapter 6. I'll do the work for you and grab the stock prices of both Visa and MasterCard as well as each company's total number of shares outstanding. Applying market value to Visa and MasterCard reveals much more than simply looking at their share price does. The analysis showed that despite its lower per share price, Visa is actually the company with the bigger total value. You figure out this. You can see that investors are in fact paying 70% more for Visa than MasterCard. Whether or not they are paying too much is another question and something you can explore in more detail in chapter 8. But at this point, It's important to start how fundamental analysis goes well beyond just taking a look at company's share price. Seeing how a company is fundamental and its price, you may get out of alignment. You don't need a long memory to remember how fundamental analysis could have helped you investing. During the tech stock boom of the late 1900s, investors were so enamored with dot-coms they were willing to pay boundless amount for them. Just a few years later, in the mid 2000s, investors repeated their mistakes by creating a housing boom that drove up share of home builders stocks. What's remarkable is there were at least two massive stocks market bubbles in just one decade. Fundamental analysis could have helped you sidestep the intense pain after both these bubbles eventually burst. Let's put one of the bubbles into context using our new tool market value. KB Ham, a Southern California home builder, was at the epicenter of the housing bubble. Back in nearly Back in early 2006, investors awarded the company with a total market value of $6.8 billion. Fast forwarded to the end of 2014. Long after the housing bubble burst, KB Ham's market value was peaked to $1.5 billion. Where did the missing $5.3 billion in market value go? Out of the pocket of the speculators, KB's Ham's market value collapsed a remarkable 78%, reaching $5.3 billion in market value. Academics argue over why bubble and manias occur with investing, and you can leave that heady discussion to them. Just know that sometimes overenthusiasm for stock can drive prices, albeit temporarily, to levels that are not justified by their underlying businesses. Fundamental analysis is one way to try to see when a bubble is forming and try to profit from it. Remember, even masters of fundamental analysis have difficulty timing bubbles just right. Many analysts had warned that tech stocks were overvalued in 1998, for instance, and they were right eventually. These investors had to wear wrong and missing out on huge gains as tech stocks continued to soar in 1999 and early 2000s. Even though they proved to be widely overvalued, investors who pay attention to companies' fundamentals are often able to at least recognize when a bubble is forming. Weak fundamentals, for instance, were the tip off for the dot-com bubble. More than a third of the 109 internet companies that failed had business models that did not bring in enough revenue or had cost too high to ever make a profit, according to Boston Consulting. Avoiding overhyped story stocks. Fundamental analysis can help you recognize when stocks are rising too much well beyond what's justified by their businesses. It's a great way to resist the story stocks trends or over few things with companies that seem to have boundless potential and grab the attention of the masses. Like clockwork, investors go gung ho over type of company, usually in a seemingly promising industry. Investors have had temporary intensity over biotech firms, 3D printing companies, social media stocks, for-profit colleges, satellite racy operators, and even retailers. Most of these spells eventually end badly. Solar City saw its stock soared 64% in early 2014, rising to the point where it is had a market value of $7 billion in February 2014, while the company was losing money in 2012, 2013, and 2014. It told investors that customers were signing up at a rapid clip and profit would eventually roll in, investors continuing to buy in. It took some time, but investors who made the effort to actually read the company's financial statement with horror were proven right. Fundamental analysts spotted two signs they are routinely looking for, including lack of profit. Even as SolarCity grew, the losses continued to mount. SolarCity lost money in 5 of the 6 years between 2009 and 2014. Just in 2014 alone, the company posted a net loss of $66.5 million. Large debt burden. The company continued to pile on more and more debt as it grew. As of September 2015, SolarCity was carrying $2.1 billion in long-term debt or debt that's due in more in a year or longer. That debt load was 50% from 2013. Despite the glowing promises of the company, investors ended up suffering as those plans have not paid out as of press time for this bill. The company's stock price had fallen by 65% from the high in February 2014 as November 2015. Once again, fundamental analysis proved correct. It's too soon to say whether SolarCity's business model will prove out, but investors paying attention to the fundamental analysis clearly know the hype was not justified at the high, avoiding a massive loss. Pairing buy and hold strategies with fundamental analysis. Buying and holding stocks over the long term can be a great way to make money. Just ask Warren Buffett. Fundamental analysis can help you keep the insights in companies to have the faith to hold on. Fundamental analysis does not require you to constantly buy and sell stocks. In fact, many investors tend to do their homework, buy stock and hold on. They realize that constantly buying and selling stocks can be hazardous for your portfolio because it may hurt you with. Mounting trading costs. Every time you buy or sell a stock, it costs you something. Certainly, you can reduce commission by opening an account with a deep discount online brokerage as described in Investing Online for Dummies. But the costs are still a factor, including ones you might not notice. Warning: there are two prices for stocks, the bid price and the ask price. The ask is price you must pay when you buy a stock, and the bid is the price you get when you sell. The ask is always higher than the bid. Just like the price you get for trading in car to a dealer, the bid is less than the price the dealer will resell the car for, or the ask. When you buy a stock, you are paying a hidden fee, which is the difference between the bid and ask or the spread. Unnecessary taxes. Flipping in and out of stock can end up making Uncle Sam rich. If you sell a stock for a profit before you owned it at least a year, it's a short-term capital gain. Short-term capital gains are taxed at your ordinary income tax rates, which can be up to 39.6%. On the other hand, if you hold onto a stock for more than a year and sell it, the higher tax rate you will likely pay is 15%. By just holding on a little longer, you can save a bundle of taxes. Mistakes. It's tempting to think that you are never wrong, and after reading this book and applying fundamental analysis, you will be more informed than many other investors. Still, it's easy to make a mistake if you sell too early. Looking to the long term, Wayne. While it's not always the case, investors who rely on fundamental analysis are often resigned to being patient and working for the rest of the world to see how great the company owns it. After all, when you are continuing on the fact the stock market and its tops of trader, portfolio managers, and other investors are wrong, you can expect them to arrive at your way of thinking overnight. Fundamental analysis often works best when paired with a passive investing strategy. With passive investing, you do all your homework, pick your stock, and then wait. The stock might fall further, but it's up to you have the courage to trust your research and wait until other investors see what attracted you to the stock. And because making money with fundamental analysis requires you to go against the crowd, you will often need to buy the stock when you think others are wrong. A few of the times where stock price might temporarily undervalue a company include the wake of an accounting scandal, when investors can no longer trust a management team because the financial statements have been fa- fal- falsified, they might sell the stock indiscriminately. If the stock is adequately beaten down to a point where you feel the company is not being properly appreciated, there could be opportunity. Warning: trying to buy a stock after it's been cooking the books is extremely difficult. Because fundamental analysis is based on accurate financial accounting, making a decision based on the false information is complicated and beyond the scope of this book. Amid pending litigation or liability claims, stocks will often trade at discounts or below their true value. When investors are worried a company might face massive claims, this has happened with companies involved in tobacco and asbestos. Slowing growth. When a company or industry matures, it may see the rate of increase in revenue and earnings slow. When that happens, growth investors who buy growth stocks may dump the stock so they can move on the new dirt. Industry shifts. Where there is major disruption to an industry, the stock in the group might get seriously punished. Following the credit crunch, for instance, stock in the financial sector lost 58% of their value as a group in 2008. Certainly, not all banks and financial firms deserve to be punished that badly. Fundamental analysts who bought the surviving bank stock at the end of 2012 enjoyed a 56% rally through late 2015, which beat the market's gain. Being willing to step up and invest in a company others want nothing to do with can be lucrative. Beat, beaten down a that get rediscovered by investors can rally strongly. Patience is not always a virtue. According to classic value investing, if you have done your fundamental analysis, you can buy stocks, forget about them, and wait a few years to count your riches. Unless there is a major changes that warrants changing your opinion, which you can find out about in chapter 10. Value investors hang on and wait for the market to wake up. Warning: don't let the fact you have done your fundamental research blind you to the fact that sometimes cheap stocks can get cheaper and stay that way. Overconfidence in fundamental analysis can turn a bad decision into a devastating one. The virtual decline suffered by Lucent shareholders is a classic example. Lucent was born out of the technology arm of AT&T, which was known for innovative patents for telecommunication and computing. Lucent, considered a blue chip by many investors, routinely showed up on lists of the most popular stocks with individual investors. The stock's downfall remains an example of the dangers of hanging on too long. The stock hit its all-time high of $85 a share in 1999 amid the technology boom. Many investors looking at the stock's falling market value figured that the company would come back. They kept thinking that as the stock fell to $75, $65, and $55, but it did not come back. The stock collapsed to $2.34, the price at which rival Alcatel offered to buy it in 2006. Remember that when you are using fundamental analysis, you are making a bet that the market is mispricing a company. If you are wrong, you need to be prepared to either be a very patient or protect yourself against extreme downside by selling before losses become devastating. This is the end of third chapter.